Okay, Assalamualaikum. Again, this is another question that I will be discussing, which is question Glory Berhad, relating to a manufacturing company located in Pekan Pahang. And this question, what we are going to do is we're going to look at the revaluation of a building, which is office building, and revaluation of land. And we are also having a question here on impairment, but I will skip that particular question on impairment relating to factory building. That will be discussed in a different session. So this one is about the company that has a piece of land. So I will put this color, land. And then they also have office building, and a factory building. So there are three types of PPE, factory building. And all of these assets were bought on 1st of July 2016. So this is the date of purchase. So I put this here, DOP. DOP, date of purchase. So if I write DOP means date of purchase. And here you have the information on what are the initial costs. Everything here is on 1st of July 16 on the date of purchase. You are also given what are the method for depreciation, and where it is monthly basis for office building and factory building, straight line method, and the estimated useful life was 50 years. And there is no residual value. So no residual value, no salvage value, no scrap value. Okay, you have this detail here about the information on first and second revaluation. So for the land, you have the information. So I'm using land, and I'm going to use yellow. So the land, the fair values of the land on 30th June 2019 and 30th June 2022, it was 9.3 and 10.5 million respectively. For your information, this is the first revaluation, and this is the second revaluation. And then you have another information regarding office building. Office building. And office building is green. So on 1st of July, 1st of July, the office building, yeah, let me just check. Okay, office building, the fair value of the office building. So I would suggest you to always highlight the information first. Before that, if you look at the requirement of the question, you are asked to discuss the accounting treatment on revaluation of land. So for the land, the one in yellow just now, you are going to discuss the accounting treatment as at 30th of June 2022. And for the office building, you are not asked to discuss the accounting treatment, but you are asked to discuss you are asked to prepare journal entry. So you need to do journal entry to record transaction related to office building for the year ended 30th of June 2022. So one is to discuss, another one is to prepare. For this one, I will KIV. I will KIV later. I'm not doing that, right? I'm just doing for number 4 and 4 marks and 6 marks. Right. So this information here, the one that you have in this paragraph, is all related to factory building. I skip this because I will be doing that in a different session. So I'll be doing the one relating to information here. And you have the information at the bottom here. Company adopts revaluation model for its property, plant, and equipment. Right. And the company closed the account 30th June. So close its account 30th June each year. So what are you going to do? You are going to calculate whether there is discuss the accounting treatment for the land. To discuss the accounting treatment for the land, you need to understand what happened to the land. So let us look at what happened to the land. So land was bought on 1st of July 16. So this is the date of purchase of the land. So I put here the cost of the land is, given the question, so you can check the information there, 10 million. Cost is 10 million. So you can always refer to your question, your hard copy question, so because that is even more effective when you refer to the soft copy, hard copy, sorry. Next. So then you will see that there is a first revaluation here, which is on 30th of June 2019. So I put here first revaluation. And that first revaluation, you have the fair value of the land to be 9.3. Fair value 1 because first revaluation, so 9.3. And you will compare that with the cost of the land because no revaluation before that. So the carrying value 1 is the cost of the land, 10 million. And you will have 0.7 million, and that was a deficit. Okay, deficit, first deficit. So of course deficit, this is the first time, so you will debit to the SOPL and you will credit to the land. And that happened on 30th of June, 0.7, 0.7 million. Then you have another evaluation happened in the second time, which is 30th of June 2022. Second or subsequent revaluation. This is subsequent revaluation. But it was second revaluation. You will compare the fair value 2, which is fair value 2 is this. Fair value 2, 10.5 million. You will compare this with the carrying value number 2. Carrying value number 2 is fair value number 1. So this one. And that is 9.3. And if you do that, what is the difference here? It would be 1.2 million. 1.2 million. This 1.2 million, you can see that fair value is more than this one, fair value less than carrying value. But this one is fair value more than carrying value. And this is a surplus. That's surplus, right? Surplus 1.2. So under MFRS 116, what is required? If you have a surplus, you cannot simply go and debit a land or credit to ARR if this is the subsequent revaluation. What you need to do is to check whether or not previously do you have a deficit. So the first one that you have here shows that you have a deficit. Second revaluation, which is on 30th of June 22, you have second revaluation. If this one is first, yeah, first, and this one is second. You have a previous surplus. So now you have 1.2. So what you are going to do is that you are going to go and debit land. That is for sure with 1.2 million. But you cannot simply go and credit land revaluation reserve or ARR land straight away by 1.2. What you need to do is you need to reverse this. So you meaning to say that you need to go and credit the SOPL, which is to reverse the previous surplus of 0.7 million, and the remaining that cannot be covered by this previous deficit, not previous surplus, that was a mistake. So previous deficit must be reversed. So you reverse the previous deficit, you credit them to the SOPL as other income, which surplus will be recorded there, and therefore 0.5 is the one that you credit to the ARR land. That was the case here. So this one will later be shown under other comprehensive income. So that was the case there. So you're asked to determine the accounting treatment. You are not asked to do this. Before you can write the accounting treatment, of course, you need to know whether there is a surplus or there is a deficit. By doing this working, it will help you to write the accounting treatment. So let's look at that part here. So just now we have already done the calculation. So on third, you are asked to explain the accounting treatment for the revaluation of land. When was it? On 30th of June. On 30th of June. So I just add here on 30th of June. Okay. Okay, the first point here. So what you need to do is, just now we have already calculated. I put it side by side so that you can see better. Okay, I will just, okay. You can just ignore the one on top here. Just ignore this. Okay. So first one, earlier we have already calculated that there was a, you asked to explain what happened here. Here, right? Here. On 30th of June here. I use a different color. Here. What is the accounting treatment for the revaluation of land? So on 30th of June, you need to first mention whether you have a surplus or a deficit. So here there is a surplus, right? There is a surplus on revaluation, on subsequent revaluation. You can see that I highlight the word subsequent revaluation because this is your second revaluation. So that was second revaluation. Amounted to 1.2. Show the calculation. 10.5 is the fair value. Show the calculation. 9.3 is the carrying value. Show the calculation. And this is the calculation that we have done. As the fair value on 30th of June is higher than the carrying amount. So that was the first explanation. Second one is that you are going to explain on what is the accounting treatment. The accounting treatment here, you need to first, as I mentioned, check if there is a previous deficit. So here our case, in the first revaluation here, there was a deficit of 0.7. So since there was a previous deficit during the initial revaluation means it refers to the first revaluation. First revaluation. So a revaluation surplus of 700,000. So there was a revaluation surplus 1.2. However, 700,000 from 1.2 will be reversed against the deficit previously recognized in the statement of profit or loss. So meaning to say that we are actually explaining this journal entry. Debit land, credit, SOPR here. You reverse because before this you debit, to reverse you credit. The next one is to explain the what to do with the remaining 500,000. The remaining 500,000 of the surplus, remaining means 1.2 minus 7.4 million, will be credited to the asset revaluation reserve. Not any asset revaluation reserve, but this is to credit them to land revaluation reserve. You cannot go and credit against other asset revaluation reserve. It must be the land revaluation reserve and shown as other comprehensive income. Do not forget to mention what is the carrying amount of the land as at the date which you are asked to explain the accounting treatment, 30th June 2022. That is 10.5. 10.5 here is this fair value 2 that you have been given. So that was the revalued amount of 10.5 million. Are you following me, class? I need some response.
Yes, madam.
Thank you for that response. Okay, next one. We go to the second part. So we have done this, right? So this you cannot just do calculation. You must do with the journal with the workings a little bit, then you can do the explanation. By giving journal, you won't get marks for this. You must write. So you can look at how I have written here, right? If you want to screenshot, maybe you can do so as well. Okay. Next, we go and look at the revaluation of office building. So I will open up this. Okay. For the office building, it was only revalued once, 1st of July. The only thing that happened for office building is only 1st of July here. So I use a different color. I use green. 1st of July, this is fair value 1. The fair value of office building is 18 million. So 18 million will have to be compared with the carrying value. So what you will do is you need to find out what are the journal entry, right? So before you can do the journal entry, let us look at the calculation of the office building, the revaluation of the office building. So the date of purchase, okay, I put it side by side again, right? So the date of purchase of the office building is here. It was 15 million. Take that, put it here, right? 15 million. And find out what is the amount on the date of purchase. Date of purchase, 50 million. Find out the accumulated depreciation from 1st of July 2016 until the date of revaluation. So from 1st of July is here, date of revaluation is here. It has been 5.5. How many years is that? 2021. And so that was 5 years, right? 5 years. 17, 18, 19, 20, 21. 5 years. So to find out the accumulated depreciation, take the cost of the building. If you have residual value, take it out. And you have to go and eliminate the accumulated depreciation. So accumulated depreciation here is 15 million minus 50. Where do you get the 50? Because you are informed the 50 years is the estimated useful life times 5. Why times 5? You want to find depreciation for 5 years since date of purchase until the date of revaluation. So accumulated depreciation here is on the DOR. DOR here means the date of revaluation. DOR. Date of revaluation. 1st of July 21. On the date of revaluation. So if I write DOR, you should know it's a date of revaluation. So 5 years. So you have 1.5 million. Right, 1.5 million. Next, you now find out the carrying amount. Take the cost minus accumulated depreciation, you have the carrying amount. So that carrying amount is 13.5. That was on the day of revaluation. So compare with the fair value. Fair value is the one on 1st of July 21, which is here. And you compare, you can see that there is a revaluation surplus. Take note, the revaluation surplus here is on initial revaluation because for the building, it was only revalued once. Revaluation. And that was 4.5 million. And this first revaluation, initial revaluation, it will be debited to the office building and it will be credited to the asset revaluation reserve office building. So this item here, this blue item here, accumulated depreciation, also may have to be eliminated. This is the one that you record as well. So the one that you will have to record in the journal, first is to eliminate the accumulated depreciation. Second is to record the surplus on revaluation. So here is the journal. So I've already prepared the journal for you here. So let me just open up in its full size. Okay. So for the, you asked to do the journal entries for what? Check your question. Journal entry for the transaction only related to the office building. Do not do for land. If you do for land, you got no marks. And this is for the year ended 30th of June, which means that this is starting from 1st of July 2021 until 30th of June 2022 for 1 year. Yeah, make sure you have your year financial year end correctly determined. All right. So let's do that. So for the office building, number one is to recognize the revaluation surplus, which is this one, 4.5 million. Credit ARR office building. This is the revaluation surplus, and this is initial revaluation. I put here initial. Next, second one is to eliminate the accumulated depreciation. So from 1st of July 2016 until 1st of July 2021, the accumulated depreciation is 1.5 million. So you will do this here, and just now you have done it for the surplus. So to eliminate debit accumulated depreciation and credit the office building. However, at the end of the year, meaning that when we do the depreciation for current year, yeah, current year charge, current year charge or depreciation, annual depreciation, you will see that you are going to provide depreciation also starting from 1st of July 2021, 2021 up until 30th of June 2022. Right. So for that 1 year, your depreciation will no longer be based on 15 million. It will be based on the revalued amount. And the revalued amount is 18 million. So the current year depreciation, you will take 18 million and you will divide with the remaining useful life. Your remaining useful life before that there was earlier on was 50, but you have used up 5 years, so 50 minus 5. So if you do that, 18 million divided by 50 minus 5, you will get 400,000. So that 400,000 is the one that you will record here to record the depreciation after revaluation, and that would be, I put a yellow here, which is related to this current year charge. Yeah, 400,000. And at the same time, you are informed in the information in the question regarding this. This one. You adopt revaluation model for its PPE and the company chooses to transfer some of the surplus to retain earnings. So earlier I mentioned to you regarding the realization of revaluation surplus. And here the company requires the surplus to be transferred to the retained earning. The surplus that will be transferred to the retained earning will be the excess depreciation. Excess depreciation arise when the new depreciation are more, the depreciation that you calculated is more than the original depreciation. So the excess depreciation can also be calculated by taking revaluation surplus divided by remaining useful life. So one way to calculate that is that you're going to go and debit them to the asset revaluation reserve, and what you will debit is by taking the excess depreciation. Excess depreciation here means I'm going to put here, I put here excess depreciation. So one way of calculating it is by taking the revaluation surplus that you calculated here and divide by the remaining useful life, 100,000. Another way of doing it, okay, I will put another working here, is by taking the new depreciation minus the old depreciation. So the new depreciation here is, if you look, I put here, new depreciation is, just now we calculated, it was 400,000. Old depreciation was based on this one, right? 15 million divided by 50. Old depreciation was 300,000. So the excess depreciation would be 400,000 minus 300,000, and you will get 100,000 to be the excess depreciation. And MFRS 116 requires this to be transferred back to retained earnings. So the difference between the revised depreciation and the original depreciation, uh, yeah, device depreciation and original depreciation, or sometimes we call old depreciation, but never mind, I put here original to use the term consistently. Original depreciation, it will give you excess depreciation, and this is the one that you transfer back to retained earnings. Okay, done with the journal entry. Okay, that's it for the revaluation, surplus realized, initial and subsequent revaluation. I will proceed with my impairment loss in our in a different session. Thank you. Paul.